The gold mining sector is, I think, discounting what I see as 10 years of deterioration of the purchasing power of the U.S. dollar. That's disguised because the U.S. dollar is outperforming all the other currencies, which is to say that the U.S. society, despite the fact it's very competitive, is losing the race to the bottom relative to the others. Now, I happen to believe that the business plan at place at Newmont is an intelligent plan. I also believe it's going to take a year and a half to play out. If you are willing to bet that they can implement the plan, you could invest now in anticipation of the successful resolution of that plan. I, in fact, am. The gold mining sector is, I think, discounting what I see as 10 years of deterioration of the purchasing power of the U.S. dollar. That's disguised because the U.S. dollar is outperforming all the other currencies, which is to say that the U.S. society, despite the fact it's very competitive, is losing the race to the bottom relative to the others. While gold is very strong in currencies outside the U.S. dollar, it's weak in the currency it's measured in. I think that'll change for reasons we can talk about later if you want to. But the gold mining industry is behaving rationally right now. They are rewarding companies that are performing, and they're penalizing companies that aren't. All-in sustaining costs stubbornly high at both Barrick and Newmont. Cash margins have been less buoyant than one would expect, given the increase in the selling price of the commodity that they produce. Margins have been expanding at places like Agnico Eagle, and they have consistently beat guidance. The consequence of that is that while Newmont is down, Agnico Eagle is up. Surprise, surprise. A company that performs does well. A company that doesn't perform does poorly. Now, I happen to believe that the business plan at place at Newmont is an intelligent plan. I also believe it's going to take a year and a half to play out. If you are willing to bet that they can implement the plan, you could invest now in anticipation of the successful resolution of that plan. To save your listeners a bunch of reading, the plan is that Newmont, after the Newcrest acquisition, will sell basically all of their Tier 2 assets. They operate too many mines now. Their management time and attention and their sustaining capital budget is split between too many competing mouths. The idea that they would take advantage of a very buoyant property market, which we're in right now, to sell the Tier 2 assets, use the cash to pay down their debt, and focus management love, time, and attention, and also sustaining capital on 5 or 6 assets that matter, is a really good plan, but they have to do it. If they are successful in doing that, of course, the gross ounces that they produce will fall. That will happen. But the margins will expand. The all-in sustaining capital costs will fall. The other thing that your listeners need to understand that is very difficult to understand is that the returns on capital employed in optimization are often double or triple the overall returns on capital employed in an operation. If a mine is put in production with an ROCE in the feasibility study of 20 or 25%, that's one thing. But after the mine is in production, when you're making smaller investments in optimization, retooling a mill, increasing the size of the haul trucks, increasing the size and efficiency of the shovels, return on capital employed in optimization can be 50%, 60%, 100%. 2, big mines are almost always put into production when there is enough reserve and resource to amortize the upfront capital expense. But those mines, in every case I'm aware of, deliver upside exploration surprises after near mine exploration commences, which is to say a mine with a 12-year mine life often produces for 18 years or 20 years. I look forward to Newmont benefiting from selling their Tier 2 deposits, improving their balance sheet, focusing their love, care, and attention on optimization, and expanding the mine lives in their Tier 1 operations. That plan will work if they implement it. It will be up to your listeners in terms of how their own portfolios do to monitor Newmont and Barrick's adherence to their plans. I'm a credit guy. I think the worst piece of debt is better than the best piece of equity on any individual balance sheet. I don't like the direction of interest rates, and I don't like duration. I own, relative to most people, a lot of U.S. Treasuries, and I don't own a duration longer than 2 years. The interest rate curve between the short and the long is stupidly disproportionate in terms of risk. And the part of the credit market that I've specialized in most of my life, which is below investment grade, is insanely overpriced. People have chased yield without any understanding of the covenants and conditions on the bonds that have been issued. Wall Street has unleashed a torrent, trillions of dollars of debt that is junk debt in the truest sense of the word. I remember the junk debt market, the below investment debt market in Canadian oil and gas companies in 1988, 1989, 1990, 1991. You could buy bonds with a cover yield of 12% that was being earned, and you could buy those bonds, 4 or 5 year bonds, at 60% of par, which meant that you had an 18% running yield and a 25% yield to maturity. The bonds were covered by net present value in the first instance and by free cash flow in the other circumstance. You don't see that in the high yield market anymore. You don't see it in a market that I'm familiar with. I would point out something else to you, Jesse, is driven by a desperation for yield. And I think that yields are actually negative. People who buy bonds believe that a deterioration of the purchasing power of the US dollar is a function of the CPI, which is to say the bogey is 2.6%. I think the CPI understates the deterioration of the purchasing power of the US dollar substantially. When I look at the basket of goods and services that I buy, Jesse, I would suggest that the deterioration of purchasing power of the US dollar is more like 7.5%. I'm not somebody who thinks that the US dollar relative to other currencies is a bad currency. Our mutual friend Doug Casey says the US dollar is the worst currency in the world except all the others. But I'll tell you that the CPI as an index is stupid. It doesn't include tax, doesn't include food or fuel. I mean, any index that doesn't include lunch is of no use to me. So for me, my bogey's 7.5%. The idea that I'm going into a 5-year junk term at 6.5%, which suggests that I'm losing 1% a year in purchasing power while taking real risk, is an insanity to me.
Rick Rule highlights the declining purchasing power of the US dollar despite its relative strength and predicts this trend could boost gold prices. He supports Newmont's strategy post-Newcrest acquisition, focusing on selling Tier 2 assets, reducing debt, and optimizing Tier 1 mines to improve margins. Efficient performers like Agnico Eagle are rewarded, while laggards like Newmont and Barrick face challenges. He also cautions against risky credit investments, citing inflation's impact on real returns. Rule advises investors to monitor gold miners' execution closely, as successful strategies could lead to significant profitability and price recovery. If you enjoyed this video and found the insights valuable, let us know your thoughts in the comments below. Don't forget to give this video a thumbs up, share it with others, and subscribe to our channel for more expert analysis and updates. Hit the notification bell so you never miss a new upload. Thanks for watching.